So just real quickly, my background is in finance. I graduated with a master's of science in finance. I also have an MBA. I had worked at a variety of different organizations through the different departments in finance, whether it was retail, brokerage, and then mostly asset management, lastly with T. Rowe Price in Baltimore. And I worked a lot with small business owners with their retirement plans, and kind of day in, day out, I got to hear the stories of their businesses. And I've always been entrepreneurial. So um, I wanted to have a business of my own. I had moved from several different organizations, and it was and I thought maybe that if I started a business, it would kind of scratch that entrepreneurial itch and I'd stop moving from place to place. And so I started looking for businesses that I believed were manager centric, but not skilled manager centric. That's a term that I've used a lot over the past year. And basically what I mean by that is I needed continuity of the business if a key employee went down. And so there's a lot of businesses out there that hinge on key employees. And if those key employees get the upper hand on you, if they know they have leverage, it can disrupt the business. Or if they leave the business, it can be disruptive. There's a bunch of different reasons why you wouldn't want to get into a business where an employee can kind of hold you hostage. And so I thought that the Quick Lube business was interesting because the manager does get a day off or two, and on those days off, some the other employees are running the business rather seamlessly. And so I felt as though that made the business model scalable. And then I also felt as though there was some gap in the service being provided to the consumer. And I think a lot of the best businesses out there get made from filling a void in the consumer space. And so I thought our industry had some credibility issues that could be addressed. And I spent a lot of time at my desk at T. Rowe Price and reading the reviews from the different review companies and kind of reverse engineering where I thought the quick lube industry should go. And I got the opportunity to take over an independent quick lube in Harrisburg, Pennsylvania, that was on a very bad downward spiral. And I got to implement my ideas to see if it worked. And I thought to myself, well, if it doesn't work, then I can always just, keep my nice paying job. 6 months in, I left T. Rowe Price and started doing it full time. I was just having too much fun running the business and building the brand. And we opened a second store in Dillsburg, Pennsylvania, which is a town of 6,000 people. And we replicated the model to see if it worked, and it did. And then the third store was in Mount Prospect, Illinois, which is a suburb of the Chicagoland area. And that was really the chance to build systems in place for absentee ownership, because I'm about 800 miles away from the Chicago area. And so I wasn't able to be there on a regular basis. And so very early on in the DNA of this business was built that absentee owner, semi-absentee type situation. And so when we got to about 10 locations, I started thinking about how do we scale this thing nationally. I thought that there was a good opportunity, especially with the incoming of the electric vehicles penetrating the market a little bit more. And so I talked to different franchise development companies to see how we could put this model into a place where we could scale nationally. I think the model resonates, and so we've been able to sell a lot of units in territories. And I think that the model that we've created has had the success because people like yourselves understand what we're trying to do with selling people their time back, with not being high pressure upsell, by being specialists and being the best at what we try to do, as opposed to trying to become a do it all type auto repair shop, full service. That's kind of the direction that some of these other competitors have gone. And I don't think that's what the consumer wants. And we're a very consumer driven organization. We've always, kept our ear to the floor to see what the consumer wants, and that's kind of guided us. And so I think the macro trend right now is for organizations that remove friction between consumers and their service or product, and that's what we do. And so it's been successful, and we've been having a lot of fun building the brand. And I think that there's a good opportunity for us to have scale and be a national brand that is synonymous with fast oil change. And so that's kind of the high level overview. It's not the full story, but it's the Spark Notes version of it. And anyone who spends any time with me, any extended period of time with me, knows that I love to talk about my business. It's like a third child to me. So I could go on, but I want to get to the Q&A because it really is the most beneficial part, especially for you guys that are may not be familiar with the industry or franchising, and can answer any of those questions. So Chris, I'll let you curate questions today since Michael is not with us.
Yeah, thank you for the introduction. The first one on my screen is Mike or Michael. If you have any questions for Costa.
One of the questions I have is, do you have some, what does the average employee make, non-manager, and how has turnover been in that level in the last year or so? Obviously, that's a big concern in the industry, in many industries, is just finding and keeping employees.
Yeah, that's a great question, Michael. And you said you're in Gary, Indiana?
Yeah, I'm actually just south of Gary.
Okay, so Gary's a great example because it's kind of our bread and butter. When we first got into this business, when I first got into franchising, I really wanted to target secondary markets like Cleveland, Pittsburgh, central Pennsylvania, not what the low-hanging fruit of the Austin, Texas, and Charlotte, North Carolina, and Miami. And so that area is something that our model typically does well with, because we are a low overhead model and we've really stripped things down to the essentials. And so in Northwest Indiana, we would typically see our full-time guys, and I'm assuming Northwest Indiana similar to the suburbs of Cleveland. So we don't have any stores in Indiana yet, but I'm assuming it's similar. We have guys that start off at $13 an hour as a full-time oil changer, and then our managers are typically going to be between $14 and $16 an hour, and we're going to have step up incentives to make them stick around based on just time served. And we have the distinct advantage in our business of being at a very base level, our employees have a interest in the subject at hand. So it's not like line cooks at a restaurant who will leave to go to a different kitchen for a 25-cent raise. Most of our guys have an inherent love of vehicles and automotive. And so that very baseline level also means that there's at some level a trade involved as well. So some of these guys have gone to vocational schools, trade schools, and so they're a little bit more sticky in terms of that. And so the other thing at play here is, because we don't base compensation on commissions and we're not breathing down our employees' necks to be selling all these unnecessary services. And we get guys from some of the competitors that are just happy to not have to do unethical behaviors in order to make a sale. And so that creates a culture within the company that allows employees to stay a lot longer. That at a manager level, we have managers that have been with us for 7+ years. We have full-timers that have been with us for 7+ years. That's not typically normal. The full-time positions, for a lot of guys that come into this space, they want to get automotive experience and then move on to maybe a dealership, or some guys want to obviously even do their own shop. And that's a real struggle right now. We're actually getting a lot of applicants for people shutting down their automotive repair shops right now, because the cost of doing business is more expensive than it's been in quite some time, especially for motor oil. And so we've recently hired full-time employees who have run their own shop because things have been so good for the past however many years. And now they're closing their shops down to come get a full-time job. And we offer that kind of security, because at the end of the day, I treat our business more like retail than automotive. And so we're very much consumers first and employees first. And so our guys get an hourly wage. We don't salary them. We don't flat rate them. We don't commission them. And so there's some security in that, knowing exactly what your paycheck is going to be. Right. In our Chicago market, in the suburbs of Chicago, we have 2 stores in Bloomingdale, which is south of Schaumburg, and Mount Prospect. Those guys are all in the $15, $16, $17, $18 an hour range. And that just comes with the territory of being in a higher cost of living area. And then, you know, our highest paid employees are typically in the high teens, low 20s for hourly. We shifted away from salaried employees a while back, when that ruling changed for the overtime laws. And so we kind of got people off of overtime and or got them off of salary and back onto hourly, and we just pay the overtime, and that's worked much better for us.
Okay.
Great. Thank you, Mike.
Yep.
Next on my list here is Decker. I believe your first name was John.
Yeah, so the construction costs, how much have they varied? Or are they typically, is your target number pretty close?
So the
California-
building,
Pretty expensive out here.
the one bay version of our building, it originally started off relatively cheap before all the different quote unquote crises we've had. It's at $340,000 right now, and that includes a $100,000 kind of leeway for site development, which is just the curbage, the greenage. You know, these are variables that towns can impose on building commercial space, like the curb cuts, etc. And so the 2-bay has moved from 350,000 to 400,000. And again, 100,000 of that has been reserved for site development. We have a line item breakdown of every expense that goes towards the building that we can share once someone enters the system, down to the ADA handrails that go in the ADA bathroom. But we're, you know, when there's a 10% increase in lumber or a 20% increase in steel, you know, 20% of 300,000 is a lot less than 20% of a $1 million building. So we're still situated pretty well compared to our peers who are building buildings right now. And the average quick lube, you know, is starting to become more than $1 million build out, and we've been able to mitigate that cost, which has been a big part of our model.
Okay.
Good question. Thank you for the response, Costa. And last on my list here, it says Petite M1's iPhone. I'm sorry, I don't have your name. You're still muted.
Hey there, sorry about that. Yeah, I'm kind of out remotely today. My first name's Nick. Appreciate you allowing me to join the call. I really don't have a whole lot. I was just kind of sitting tight, wanted to jump on the call and listen today, kind of early in the process. But I do have a quick question just around the real estate aspect of things. You know, in the model, what's the most advantageous, I guess, in terms of lease versus, you know, building out? Is there a preference, and kind of, can you speak to that a little bit?
Yeah, the investors that we use to finance the construction of the building would prefer what's called a fee simple real estate transaction, and that's when the land and the building are owned by one person. Ground leases are the least the path of least resistance in terms of just getting a ground lease signed and putting a building up, but it does complicate things because now you're doing an improvements lease on the property, and the landlord doesn't own the building, the investors own the building, and it's not always easy to parcel out some of these lots that are, you know, we're going after very small pieces of land. So when possible for the land to be sold with the construction of the building, that is the ideal for the investors. But in terms of actually going out there using our national broker, our master broker, or you yourself pounding the pavement looking for space, you know, going to a landlord right now and telling them, hey, this parking lot is, you know, empty 90% of the time, we just want 1,500 square feet for a cheap ground lease. You know, that's a pretty low barrier conversation, as long as you can get past any kind of gatekeepers like brokers and stuff. So we use a master broker in the history of franchising, really McDonald's is the only one who has been successful at mandating that franchisees go where they tell them where to go. So at the end of the day, site selection is on the onus of a franchisee. And so we provide tools and assistance with trying to find space, but at the end of the day, the franchisee is responsible for that site selection. And so if you're comfortable with a ground lease and an improvements lease on the building, then that is, probably one of the quicker ways to get things going. But buying land and then selling it to the investors, or traditional construction finance loans are really difficult right now, especially for a building this small. Banks would much rather finance $2 million. It's much easier right now for you guys to go out and get $2 million construction loan than a $300,000 construction loan. And so it's difficult if you want to do it yourself. That's why we've created this program in the first place, was to use our scale to have that dollar amount be enough to, make the juice worth the squeeze. So in any case, it really comes down to what your preference is. Some people view a lease as less risk. Some people view it as more risk. So it's kind of a personal answer to your preferences.
Okay.
This is John. Did I hear you correctly? The investor or the company that you guys utilize, they would prefer to buy the land and put a full package together?
Correct. As long as it's within the bands of what we're looking for. So just like if the land is $100,000 and the building's $400,000, that end rental rate, which is a 10% markup. So just using round numbers, if the total cost is $300,000, you multiply that times 0.10 divided by 12, and your monthly rate comes out to be $2,500. We don't want our franchisees paying over $6,000 a month combined between ground rent and building rent. And so if there's an opportunity to buy land for $200,000 and put the building up for $300,000, that still works within the bands of our model. And the investors would prefer that situation. So there are times where buying both would be could even translate to a smaller total output of money towards building cost.
John, again, that 600,000 in paying the 6,000 in California, that's going to be a tough standard to get under.
Well, and in California, we're seeing more of because we have Sacramento, we have 3 California franchisees, I believe, and we've gotten to LOIs on ground leases more easily than trying to actually purchase land, because everyone in California thinks their dirt is worth a lot of money. And so the ground lease is more an easier conversation, especially for some of these strip mall owners that they've lost half of their tenants to their, being outpriced. And now all of a sudden they're more willing to entertain a $1,500 ground lease because they lost their $5,000 a month, 1,000 square foot Rita's Ice or whatever the case may be. California just capped the ability for the auto repair business in general with that decision that was made a few weeks ago or a month ago on sunsetting out the ICE engine. The minute they made that decision, that devalued auto repair across the board. And so we'll see what the actual fallout of that is in terms of what they're going to do to stymie people from going over to Nevada, and maybe they'll block registration, but that's going to be determined. But just the act alone of doing that, landlords that own automotive space or automotive zone space, they're going to have to be more reasonable about what their land is worth, or it's just going to sit vacant. So that's kind of their options going forward.
Okay.
This is Nick again, just speaking to that topic for a quick minute, just about the potential of other states adopting, the 2035, that whole deal. How, what's your thoughts behind that? And if those changes take place?
Yeah, so California won't be the last state to phase out new sales of ICE engines, but it'll be a question of how much pain can a state take before they revert back to allowing, what kind of economic fallout are they going to allow before they go back to allowing it? It's kind of like Germany right now firing up nuclear plants after shutting them down not that long ago because they're about to have an energy crisis. And so at the end of the day, there's 340 million registered internal combustion engine vehicles in the country. If that's even cut in half, that there are industries built on consumer bases smaller than 70 million of their consumer base. And so what we aim to do is scale at a rate that allows us to grab that market share of being the oil change only option, while some of our competitors are completely content going down the road of being all of the above and multi-care this and just becoming another Monroe, Meineke, Pep Boys, etc. We feel as though if we can grab that market share, then it won't matter if the internal combustion engine goes down 50%, because the other thing we have to remember is our electric grid cannot even handle if 20% of cars on the road were electric, let alone 50%. And so there has to be massive infrastructure upgrades in order to even get to the point where half of the consumer base is gone. And this is a conversation that we could have for a really long time. And it's important for me to have the most up-to-date information on what's going on. I think we all saw California the other day was kind of getting ridiculed for telling people not to charge their electric vehicles a week after making it that ruling.
Days after.
And so I have no doubt technology will get better and things will get to the point where the grid is better and it'll eventually figure itself out. But at what scale and how long, there's a couple statistics that are a little alarming right now that work well for us as oil change operators. The average car loan is now exceeding 8 years. It used to be 60 months, and now you go out to buy a car and the first thing they offer you is 72 plus months, and it's getting even higher. And so when people and vehicles depreciate so rapidly, if you get into this cycle where your car is underwater and you can't even get out, then the only thing you can do is maintain it and do the proper maintenance to make that car last. And that parlays into this next statistic, which is cars on the road are the oldest they've ever been. And so that has partially to do with financing of vehicles, but it also has to do with the quality of vehicles are the best they've ever been. When I was in high school, a Nissan Sentra was not a car my parents would allow me to get into. And now a Nissan Sentra, a Kia Optima is a very high quality vehicle. And so there's no such thing as a bad vehicle rolling off the lot anymore. And so cars are lasting longer. So even if you outlawed new internal combustion engine vehicle sales today, just say, Bernie Sanders becomes president and we ban internal combustion engines tomorrow. So there's still a runway of at least 14 years based on the amount of internal combustion vehicles that are on the road right now. And that would slowly decline and the market share would get bigger and bigger as the electric vehicles penetrate. But and then there's also, just from a political standpoint, there's a segment of the population that on pure principle will never buy an electric vehicle just because they want to be spiteful. And so there's that aspect as well. So
there's a lot to add on top of that, Costa, and you hit some great ones, but those batteries need to be changed every 3 to 5 years, and they're 15 to 20 grand every time. There are a lot of Tesla owners that go in, they'll just say, you might as well just sell it and get a different vehicle. So they've got a lot of headwinds. They've got to.
And technology will solve those problems.
Eventually.
Those problems are a lot easier to be solved with better batteries and better, but the infrastructure is a much bigger problem. I mean, I remember when President Obama did the infrastructure bill, and we're still talking about our bridges today, and we spent it seems like infrastructure is something that we can never get right in perpetuity. So it's like, how long will it take for the grid to actually have the ability to sustain charging all these vehicles overnight at the same time? Because, the people are going to use them the same way they use your phone. You go to bed at night, you plug your phone in. You go to bed at night, you're going to be plugging your car in. And if everybody's charging at the same exact time, like, that's going to be a huge strain, especially if we continue to ignore the reality that nuclear energy is the cleanest and most efficient energy. And no one seems to want to have that conversation yet. And so we're going to be pretty reliant on petrochemicals for quite some time.
Thank you for that. Quick question too on the, well, I don't know if it's a quick question, but the questions around retrofitting existing locations versus kind of a new, putting the new building up. What's your thoughts on that?
Yeah, conversions are great. We believe enough in our model that we think that if we can go into a conversion at the right rental rate, that we'll be able to get past that ramp up period and succeed where someone else may have failed. There's not a lot of these facilities available because it's pretty difficult business to fail in. If you treat people right, it's a lot like a barbershop. Once you find someone that cuts your hair the way you like it, you keep going back to them until they give you a reason not to. So our biggest problem is, unless you're a first-time driver, you're firing someone else to come to us. And so, typically people make their consumer decisions based on three things, which is price, appearance, and experience. And so we know that our model is based around the experience. We know that our model is based around the cleanliness of the shop and the presentability. So really, we have to use discounting methods, couponing, Groupon, all the things that businesses hate to do, but we have to get past that ramp up period because and when I talk about the ramp up period, it's something that's inherent to automotive. If you make the best pizza on the block day one, someone might eat there 5 times that week. They can have lunch there 5 times that week if they like it enough. If you give someone the best oil change they've ever had, that vehicle will not be back for another 3 months, no matter how good of a job you did. You might be able to inspire some word of mouth. You might be able to, get some of that, but that particular vehicle that rolled through your doors on the grand opening does not come back for at least 3 months. And so that's what we say by ramp up period. But in the same vein, once you do get that person in your doors, the retention rate's pretty high. So it's a reliable business with pretty predictable income.
Thanks, Nick, for your questions. We've gone around a couple of times, Michael, John, and Nick. John Bowles, did you have any questions to add?
No, you've covered a lot of them. Excuse me. I guess one of the questions that I get frequently that maybe Costa you can speak to a little bit is kind of the ramp up time. So somebody signs a franchise agreement today. What does that runway look like for, kind of a short end of the runway to the long end of the runway?
Yeah, that's a good question, John. So, there's a lot of variables in the beginning because site selection is such a process handled by the franchisee, and a lot of it is dependent on the effort that the franchisee puts in. But let's just say you enter the process, you find a space, you get the maybe let's just go with a conversion because the conversion is an easier one to visualize. So you sign a lease. Hopefully we've negotiated some free rent for you so you can do some improvements, do the signage, get it converted. You get your certificate of occupancy and we schedule a grand opening. All right. So we have our grand opening and then the clock really begins on that ramp up period where it's going to be about 3 oil change cycles before people start overlapping, and 3 oil change cycles is about 9 months. Now, if you go back to a conference that Valvoline had with Goldman Sachs, and Valvoline at the time was the only publicly traded quick lube in the country. Now Driven Brands has gone public and Driven Brands owns Take 5. So there's a lot more information available now, but Valvoline stated in this webinar they did with Goldman Sachs that they expect their corporate stores to have a ramp up period of 3 years, and they expect their franchisees to be 4-year ramp up period, and that's when their store will be what they consider mature. I don't believe our ramp up period is the same as that. Our cash outlay is not nearly the same as a Valvoline, and we're not doing nearly as many services as a Valvoline. So I've pinned a lot of our stores at a 9-month ramp up period, where by month 9 and 10, you should be seeing a lot of overlap of customers. You should be seeing a lot of return customers, and you should have a mature book of fleet customers at that point. And so in terms of the expenses that it takes to get one of our stores open versus someone else's, plus the labor cost, plus the rent cost, you know, I like to say 9 to 12 months as opposed to 3 years, but it certainly can be longer. It can be shorter. We have a store in Gibsonia, Pennsylvania. If you guys want to Google Gibsonia Costa Oil, it's on an outlot of a grocery store, and you know, they did 38 cars on their grand opening, and they never did less than 15 cars a day from that day forward, and it's been a good store from day one. But then there have been stores that we open, and you know, they'll have a good grand opening, and then they trudge along at 3 to 6 cars a day for 6 to 9 months before it starts, you know, really becoming exponential and multiplying, and that's also a possibility as well. So some of it is dependent on the market, but also, you know, we have marketing ploys, or not ploys, that makes it sound like you're tricking people. We have marketing techniques that we use to help assist when you have that ramp up period. And so we do a lot to combat in that ramp up period as well, to try to get people in the doors. And a lot of it has to do with your stomach for couponing and working at a lower margin, and you know, but customer acquisition is so important in this business, because as long as your guys are doing the right thing in between those 2 doors, those people will all come back. So if you have the patience and the ability to make it through that period, it pays dividends in the end.
This is John Decker. How many cars is basically your break even per average per day, your break even where you cover all your costs? Typically,
yeah, that would be a financial representation, which the FTC doesn't allow for us to do. So I can point you towards our item 19, but also I can have Chris or Michael give you there's an industry publication from our leading magazine called the National Oil and Lube News, and they compile statistics across the country for car count and break even and average salaries and all that. And then you can kind of reverse engineer it yourself. But you know, there's so many other variables involved as well, because you know, I have a store that my rent is $800 a month and my manager is $14 an hour, and that's in Youngstown, Ohio. So I don't have to do nearly as many cars there to make a profit as I do somewhere that might be doing way more cars, but the lease is $5,000 a month and my manager is $18 a month. So it's a tough question as it is, but I think you can find some answers within the industry guide that I can have Michael or Chris give you.
okay.
I just sent Michael an email for you, John, to send you the NOLN survey.
Okay.
Yeah, because ticket average will affect that as well. So our Mesa, Arizona franchisee, his average ticket is almost $80, whereas our company as a whole is about 70. And he's just in a more expensive area. We don't dictate pricing top down. We allow our franchisees to gauge their market. And so there's so many variables involved that could change those things. If you were to shop around your local Jiffy Lube and Valvoline and Take 5 and Grease Monkey right now, most of them have moved their full synthetic oil change to $99.95, and we're still capped at, we're at $74.99 in some stores like Cleveland and Pittsburgh, and then some of the other stores were at $79.95. And so that just comes from, you know, me being able to dictate the prices top down, and I'm doing it purely for customer acquisition, because every day that I can hold firm at $79.95, I'm stealing people from people getting sticker shock at Jiffy Lube or Valvoline for $99.95. So I implore everybody, do some market research, call your local Jiffy Lube or Valvoline and see what their prices are for synthetic blend and full synthetic, because we're $39.95 and $79.95.
Okay.
Good questions. Great questions, everyone. We're coming up. We've got 5 minutes left. So I want to give everybody one last opportunity to ask questions while we have Costa's time, and then we'll let each other go. Anybody can randomly ask. We don't need to go in order. If there's something on the top of your mind.
Well, I hope everyone had a good Labor Day weekend, and if we're not having Discovery Day this month, but we'll be returning in October. So if anyone wants to join us at the HQ, we kind of get into the secret sauce, some of our vendor relationships, some of the things that make us us, and so Michael and Chris can help out with that.
Great. Well, thank you, Costa, for your time again. He has this every Tuesday morning. So if any of you guys would like to attend again, please get in touch with myself or Michael. And John, good to see you again. Have a great week, everyone.
See you.
Thank you.